When we look at the S&P 500 over the last week, we see a lot of strong performances from the big names, the likes of Microsoft, Apple, Nvidia, Broadcom. However, when we do take a look at these growth companies, they all return a similar valuation grade of F, looking like they are potentially overvalued. Again, the same applies for Meta platforms, as we can clearly see for Apple. Now, in today's episode, what we want to do is take a look at 5 undervalued growth stocks. Now, each one has a lot of upside. The first one we are looking at is Lululemon Athletica, which over the last 12 months has suffered heavily, down 21%. As we can see right now, it is trading at its 52-week low, and we get a double buy rating seeking alpha Wall Street, although we do see that hold from Quant. And on a forward P, it does sit a somewhat attractive 20.81. Now, for those that want to know, the S&P is around the 23 mark. And in terms of the historical performance, well, if you were a shareholder over the last 10 years, you would have not just outperformed the S&P 500, but you would also be up around 643%, which is a very strong performance in any asset class over this period. Now, when we take a look, one thing that we like to look at with each one of these companies is their historical performance, and as you will pick up, they all have the same theme. Lululemon, as we can see, over the last 4 quarters has beaten analyst targets quarter on quarter, and over the next 4, they are anticipating double-digit increases to that earnings per share year on year. When we go as far as January 2026, if they are able to capture that earnings per share estimate, their forward PE will come down lower to around 18.7. Again, it does depend on whether or not you do have confidence in management and their estimations. When we take a look at this company, it has something we love to see, free cash flow growth over the longer term, and again expected to continue over the next 12 months. Their sales growth, as we can clearly see, every single year, double-digit increase, and even though there is some element of inconsistency, we still note some very strong performances over the period, and we can clearly see that growth hasn't slowed down over the last 10 years, 1.8 billion to 9.6. When we take a look at the ROIC, a very important metric, as always, 10% or more is what we aim for, just to give us faith management are able to effectively allocate their capital, and that is very clear to see. One thing we love about this, not just the high ROIC, but also that consistency. On top of that, operating margins very strong, above the 16% minimum we want to see. Free cash flow, the same to say as well for the margin, above the minimum 5%, 17 in 2024, 18 on a trailing 12-month basis. When we then take a look at the net debt to EBITDA, which ultimately shows us the strength of the balance sheet over the last 5 years and expected over the next year, 0, which gives us confidence that their balance sheet is incredibly strong. In fact, it shows us that it wouldn't even take them 1 day to pay off all of their debt net of cash on hand. Now, in terms of our valuation for Lulu, we do get an intrinsic value of $407. The way we work this is we put it through the discounted cash flow model, where we have the free cash flow growth year on year. The average growth is 19%. Now, what we have used for the 2024 is what management are expecting to hit, and therefore, based on that, with a growth rate of 19% and a discount rate of 8%, we get the present value of future free cash flows and terminal value. We add with the cash, subtract total debt, get to the equity value, which we divide by the shares outstanding, and you can clearly see higher than the market price. Now, typically, we go through 3 different rates. For this company, we have a low of 15, a medium of 20, and a high of 25. Just to show you what we mean, for example, if we were looking at a high of 25, we would put it in the model here, 25%, it would give us that intrinsic value, and if that is something you do believe the growth will be over the foreseeable future, that would be upside to this company at 95%. Now, typically on this channel, we do like to use the medium rate, but instead of using 20% today, we have just gone for that average growth of 19%. Don't forget, as always, you can grab a copy of this model by clicking on the pinned comment below. This then takes us into the final slide. So we have the intrinsic value at $407. Remember, that is a 19% increase to the free cash flow year on year. We always start off with a margin of safety of 10% on this channel. Execute on that if it meets the 3 criteria: wide moat, strong financial metrics, good forward-looking data. But look, if you believe that for Lululemon Athletica, a buy up to $366, then we keep going till it's near the current trading price. And in today's episode, we do see quite a nice MOS level, not at 30% yet, but it does sit somewhere between 25 to 30%. Again, will depend on what you look for in terms of your investment strategy, but we can clearly see Wall Street do like this stock a lot. They don't believe that it is warranted the massive share price drop we have seen. $409 price target, 37% upside over the next year. The next stock we have is Ulta Beauty. Now again, we get a double buy rating with a hold from Quant. Again, similarly trading at its 52-week lows with a forward P sitting around 15.13, and again down 19% over the last 12 months. If you've been a long-term shareholder, not a strong performance as Lululemon, but still you would have outperformed the S&P, and we can see recently all-time highs around that $575 mark. Now, in terms of their performance, well, look, this is what we love to see. They've beaten the analyst targets 4 out of 4 in the previous quarters. Now, we do notice the next quarter where they are due to report imminently, they have negative 8% anticipated, but we can see over the next 3 quarters, it is expected to pick up. Hence why in January 26, they are estimating an increase to the previous year. And again, that forward P will drop down to around 13.75, which does look incredibly attractive for what we believe to be a high quality company. Again, we get that theme of increasing free cash flows over longer term, and we can see over the next 12 months, it is anticipated to move in the right direction. Nearly double-digit increases over the longer term. We do note that COVID year where it was justifiable for the drop, 10% in the more recent year. Again, nearly 4 times their top line over the last 10 years. And one thing we haven't mentioned is shares outstanding. We love it when companies do those share buybacks, returning the excess cash to your pockets. And that is something that Ulta Beauty do clearly do, something we will expect them to continue to do with this share price looking incredibly attractive. ROIC, well, double digit nearly every single year. Very, very attractive. These are some very strong numbers. Maybe you're seeing these quite often on this channel, but don't take this for granted. When we do look at other companies, they're not typically as high. Operating margin has increased over longer term, although marginally. Again, we want around 16%, so not too far off that level. Free cash flow margin over the last 5 to 6 years looking pretty decent. We then look at the net debt to EBITDA. Again, very strong balance sheet, 0.49 in 2024, marginally higher over the next 12 months. So again, similar to Lulu, Ulta Beauty does have a very strong balance sheet. When we talk about the valuation of this company, we get to $564. Now, where this comes from is that we have used a 6% growth rate, which we do believe to be incredibly low. But again, as always, on this channel, we do want to be more conservative. As we can see, a low rate of 4%, just to show you here, would indicate value of $485 that we can see here, upside of 24%. Now, yes, we have gone for 6%. Don't forget, if you do grab a copy, you can put your own numbers. So if in actual fact you think 12% would be more accurate, you can see that the share price of this company looks severely undervalued. In fact, it would be more than double the current trading price. But again, it will be estimations on how you see the future of these companies. So at a 6% growth rate, which is very low for this high quality company, $564 would be a very nice margin of safety. Remember, 10% itself would be $508, so a lot of headroom. At 20%, $451, and again, we just keep going until we're near that current trading price, and we can see in today's episode 30% for Ulta Beauty. So we see more of a margin of safety for this company than Lululemon, but again, both high quality companies. And in fact, Wall Street do indicate some very nice upside, not as high as our intrinsic value, nonetheless 25% over the next 12 months. And as always, let us know your thoughts if you are adding to any of these yourself. Now, just to let you know, tomorrow we are releasing our weekly article completely free. We're going to run through 49 dividend kings. We're going to give a lot of information, what we believe to be upside, and whether or not we see these companies as undervalued. So if you are signed up to the free weekly newsletter, you will get that copy tomorrow morning. And as always, you can click the pinned comment below, sign up, and you will also get access to all of these articles. It is all completely free, and again, you can read these straight away. The next one we move on to is Okta. Now, why I really find this interesting, the first time in a long time we see a strong buy from Quant. Typically, they have hold ratings. We get a double buy from the other two analysts, and we can see trading in the mid to upper end of the 52-week range. Forward P, 39.71. We're going to come on to that shortly, but again, some people may find that a little bit too costly. Over the last 12 months, well, up 37%. However, over the last 5 years, we do see it down around 25%. all-time highs sitting somewhere around that $290 mark. Now, when we take a look at their earnings, well, again, very nice theme that we have going on. They've beaten all 4 of their estimates over the last year, those 4 quarters. Some incredible growth expected over the next 2 quarters as well. And again, if they do expect to hit those numbers in January 2026, it will come down to around 35, and we will estimate that if they continue this trend, it will start to come down further and further. In terms of some of the underlying metrics, yes, negative free cash flow, not something we like to see, but from 2020 it has turned positive, moving in the right direction. $298 in 2024, expected to go higher in 2025. Again, positive signs of companies that we do like to see, especially those that are very high growth. And as we can clearly see, even though the top line numbers have started to come down, 22% in 2024 is still very, very strong to see. One thing we would say, those shares outstanding, they would have diluted your position as a shareholder over the last 10 years, and we can clearly see that growth in the top line sales. ROIC, now the reason for this, they haven't yet turned a profit, hence why it is negative, something just to consider. Again, clearer to see when we look at the operating margin. One thing we would say, it is moving in the right direction, it is getting smaller and smaller. Hopefully over the next few years we can see them turn a nice profit and get into positive territory. In terms of free cash flow margin, well, look, over the last 5 years it has looked very strong, 24% on a trailing 12-month basis, something we always like to see. Remember, a minimum of 5 is what we want. Net debt to EBITDA, will look, over the last 4 years and over the next year, anticipated 0. Very strong balance sheet. Again, always something that is a big bonus for investors. So our intrinsic value at $113 for this company is generated by a median rate moving forwards of 12%, and we have used their estimated free cash flow for 2024 as a starting position. But as we can see, depending on what you would use, you would get different upside. Again, for those that believe maybe this is way too conservative, for example, 20% would indicate more than double the current value. As always, that median rate of 12% that we have taken through does give us an intrinsic value of $113. Reason why we show this is so you can understand whether or not you agree with this, and maybe if you don't, what sort of levels you would be looking at depending on that growth rate. So a 10% margin of safety would indicate a buy at $102. Then we keep going at 15%, pretty much on that value right now. So if you believe in this company, do bear in mind this is a 15% margin of safety if you see this company growing around 12% over the next few years and beyond. As always, if you do see different rates, that number will be slightly different, but we can also see Wall Street marginally higher than that intrinsic value. They see upside of 20%, so they also agree with that free cash flow growth just over the foreseeable future. As always, do let us know your thoughts below. We then move on to SentinelOne. Nice to note, a triple buy rating from every single analyst. It is trading in the mid to lower end of the 52-week range. Again, forward P we will cover, but that does look very, very alarmingly high. Over the last year, up 35%. And when we take a look at their earnings, again, very positive to note. Over the last 4 quarters, they have beaten. In fact, the next quarter, they are anticipating growth of 96% year on year. So this is a very fast growing company. That is shown through the growth of the earnings per share estimate. If they do hit that 0.23 in January 26, looking at their track record, it could be better. That forward P will come down, and again, we would expect it to come down further and further at a rapid rate given the growth this company has seen. When we take a look at their free cash flow, well, it is negative, but what we can see over the next 12 months, it is anticipated to turn positive. And one thing that we always like to mention, this is where you will see a lot of massive gains in company, where you buy them at the point where they have turned from negative to positive. But again, you have to consider whether or not you see that consistency over the next few years and beyond. Sales growth, triple digit growth from 21 to 23. It has come down in 2024, but if it does still continue at a very rapid rate of double digit, again, this will still be a very strong growth company. We can see both share dilution on the shares outstanding as well as some nice growth to their top line. In terms of the ROIC, well, we do get to see negative across the board, hence they haven't turned a profit. And we can also see on both the operating margin as well as the free cash flow margin, historically speaking, they both have been negative. What is quite nice to note is that over the next 12 months, the balance sheet strength is anticipated to drop down to 0, but we can see historically it has been fairly high. Definitely something to keep an eye on. When we take a look at the valuation, well, we get to a value of $25. Now, this is definitely worth explaining. What we have done here is we have used some very high growth rates. We do expect this company to grow at a very rapid rate. but today's episode we are using the 40%. Now this isn't necessarily what we see over the future, but we want to basically go off what the essential target price has been by Wall Street. So on a 40% growth rate, we do get to a value of $25.14, which as we can clearly see is pretty much what Wall Street are estimating. So Wall Street see this company, SentinelOne, as we can see here, growing at 40% of their free cash flows year on year. Therefore, if you also agree in line with Wall Street in terms of the margin of safety, 10% would be around $23, 15% around $21.37, and we can see in today's episode pretty much around a 20% margin of safety. Remember, this is a fairly high estimation, and this is based on Wall Street and what they are predicting. So again, whether you take that with a pinch or salt, you are getting a 20% margin of safety with upside of 23%. This then takes us on to Aptiv PLC, where we get a double buy rating and a hold from Quant. It is trading right there towards its 52-week low with a forward P of just under 12. When we take a look at the performance, well, down 32% over the last 12 months. Over the last 10 years, however, it is up 20%, and we can see here all-time highs around $180. Now, when we take a look, again, every single growth company we have looked at today has beaten analyst targets, which is always a great sign. And with this one, in the future, they are anticipating over the next 4 quarters, double-digit growth to the earnings per share. Again, if they do hit that December 25 EPS estimate, forward P does come down very attractively to 9 if you are happy with the quality of the company. We then take a look at the free cash flow per share. Very, very inconsistent, something to consider, but nice to note over the next 12 months, anticipated a nice increase from 2023. We then take a look at the sales growth. 3 of the last 10 years have been negative. Nice to note the last 3 years have been double-digit increases to the top line, as well as the trailing 12-month. On top of that, they have increased their total sales. It is a little bit inconsistent, so bear that in mind. And inconsistency doesn't stop there. They have issued shares as well as diluted shares over the last 10 years. In terms of ROIC, at least that minimum level in the more recent year at 10%, but across the board, some very strong years, some years where it is sitting in these single digits. When we take a look at margins, again, a lot of inconsistency across the board, so whether or not that is something you are satisfied with, depending on that margin of safety, just something to consider. Net debt to EBITDA, 1.89 in 23, still very strong, 1.62 over the next 12 months. Again, a strong balance sheet, very similar to all of the other stocks today. In terms of the valuation, well, first thing to note here is that Wall Street do see a lot of upside. Their price target of $107 estimates 53% over the next 12 months. And when we take a look at that growth rate, again, the median rate of 10% does give an intrinsic value of $96. So if that is something you can see achievable with this company, then that is around 37% towards the upside. If you believe that is way too pessimistic, well, 12% would indicate 62% upside. Remember, again, you can grab a copy. Maybe you think this is actually too optimistic, and you can go for 4%. As we can see, it would give an overvaluation sign. So at a 10% growth rate, we can see then the margin of safety at 10% would indicate a buy at $86. At 15% around 81, and at 20% you would still be looking like it is a buy. It does have in fact a 25% margin of safety in today's episode. If you're waiting for 30%, that would be around $67. So this does look like a very attractive company in relation to the margin of safety and the upside that Wall Street are predicting. But remember, some of the metrics that we have gone through does show some of that inconsistency. Definitely something to take away, do some due diligence before seeing whether or not this is one to consider for the portfolio. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button. Let us know your thoughts below. And as always, we'll see you all on the next one.